Welcome, everybody, to our Trading Index Options webcast. I'm Connie Hill. I'm happy to be here, and I'm happy that you've joined me here as well. One of the things that we've been working on in this class is developing some systematic rules that we just want to develop some consistency, do the same thing time after time. And we've been working on a couple of different investing plans for that. This week, I've realized we have a few loose ends that we need to tie up in both of those plans. And so that's going to be one of my objectives today, that we're going to maybe nail down some rules, and I'm going to ask for your opinions. I might not accept your opinion, but I am going to solicit your opinion into if you think maybe X or Y or whatever we talk about is a good thing to add to our rules or not. Okay. Those of you that have been trading this in your paper money account, just kind of practicing, you guys might have a little bit more insight if you've been kind of tracking the particular rules. And so anyway, that's what we're going to have some fun with here today. I hope you're following me on X. I'm Connie Hill, CS. Now, I think Barb is in the chat. Who's in the chat today? Oh, it's James Boyd. Oh, James and Barb are totally different people, right? James Boyd is in the chat. He is James Boyd CS, and we'll both post educational content out in our X accounts as we notice different charts, things that are going on in the market that we think you might find interesting. We will share that information with you. Let's go through our disclosures and get going in with our agenda here today. What we talk about is for information and educational purposes only. Don't consider it a recommendation. Past performance is no guarantee of future results. For the sake of simplicity, we will not bring into consideration commissions, but no, you want to make sure that you are taking into consideration the commissions when you do a trade. When an option is at or near expiration, you need to consider the specific risk to our different strategies. When we talk about probabilities, keep in mind they are theoretical in nature and not guaranteed. We will be using the Paper Money software application. It's for educational purposes only. I think it's a fantastic tool and encourage you to use it as you're working out different rules you want to follow, working out different routines so that you can feel comfortable with it when you go ahead and move to your live account. So it's a fantastic tool for that. All right, I'm going to ask you just up front, how many of you are doing some version of paper trading with the SPX options? Now, SPX is not the only index that we could trade, but it is kind of the most popular one. And there's so much liquidity in it that we've really focused on it, okay? So I'm curious, and I'll go ahead and chat in for me. Let you know, we've got a few events coming up. So this weekend, if you're anywhere near Dallas, go down to the Market Drive event. It is different than the workshop if you've been to the workshops. The Market Drive events are very specifically talking about what's going on in the market right now, what's driving the market. And we have some additional people that show up so that you get some various ideas. Then the next week we'll be in Orlando for a workshop, technical analysis and option strategies. And then New York at the end of August for an advanced options workshop. If you can get to any of those, it will be worth your while. All right, who is trading this along with me? Excellent. Bogus, Jay Richardson, Michael, Eric, Rodney, Mr. Lashinos. I don't know, Lashinos? I don't know if I said that right. Sharon, you're doing the XSP? Perfect. All right. And Riceberg, you're hanging on to the old time or the old format. That is actually good. Yeah, I'm glad that you're using that. Very good. Kevin as well. Excellent. VA, I kind of skipped over this one. VA Anderson says, have been trading for 7 months. Losses occurred when price is near the 20 or 50 SMA. Oh, or maybe greater than the 50 SMA and something with the 20. You say very hard to see positive movement in 7 days. Interesting. As VA Anderson, as you have questions, or I guess V Anderson, as you have questions, maybe because you've been doing some paper trading at a kind of bring something up, feel free to let us know about that. Okay, let's move over to our Thinkorswim. Now, I did change the color on this, and I received some feedback that the black one was hard to read. So I said, okay, we'll do the white one for a little bit of time, see how that works. And some suggestions were, oh, that graph, when it's just white, it is so blinding. It's hard to see very well. So we're trying a light blue color. You can let me know if you like the light blue. We may not. That's okay. If you have a strong opinion, go ahead, let me know. First thing I want to do is talk about what has happened, what trades have happened since we were together last. Okay. So we're going to do a couple of things. One, when we left our class last week, we had one short vertical that we had put on, short put vertical, for rules, or for, I should say, the rule structure of adding the market forecast. And then we added one as well because it met the conditions for our linear regression model. And we had both of them going. They were different strike prices because the strike price selection is a little bit different in each of those scenarios. So let's go and start there. So we had those on during our class. And let's maybe collapse this for now. And just as soon as our class was over, it executed 2 trades for us and got us out. We had sold those credit spreads, and we have an order in there. If we get 50% of it, then we want it to check us out, right? Buy it back, be done with the trade, lock in the gains. So 22nd was the last day that we are in class. Okay, you guys are liking the light blue. Okay, good. Bogus chinchilla, I'll show you in a minute how we got that blue. So here's our 22nd. And we had, let's see, that's the getting out order. This is the earlier order. We had a $2 credit on one of them, and we brought in $2.50 on the other one. Well, promptly after our class ended, 4 minutes afterwards, what did it do? It took both our orders. We had said buy back at 50% of the $2, which would have been $1, and also 50% of the $2.50, which would have been $1.25, and we had been happy campers. But it went ahead and executed it, and we got to keep most of the premium. It only charged 50 cents for that. Now, one of the questions is that realistic? This is paper. Sometimes paper is a little bit nicer to you than a live account is. I will say at the end of the day, trading day, and at the beginning of the trading day, sometimes you get some of those weird orders that work in your favor, just because you're getting matched up with market orders. And so it could have gone on that way. I'm going to say in this case, it was probably a little bit nicer than it needed to be, but we probably could have been matched up with some market orders. So what did I do? I hurried and put on 2 new trades. All right, that happened at 13:49. At 13:51 and 52, I threw in some new trades for us. Okay. So we had one that was a $2 credit, and the other one was a $2.30 credit. One went to our linear regression based on those rules. The other one was based on our market forecast rules. Well, what happened with those? Well, we had let's see, the next day was, well, this is on a Wednesday, and then on Friday, this is kind of interesting. Right first thing in the morning, our spread that used the 72.90, 72.70 spread, which was this one here, $2.30 one, it went ahead and stopped us out. Okay, and you can see, oh, bummer, it hit our stop. And on that one, I believe it was I think I set it up to do 2 times whatever the opposite of what the credit was that we brought in. To validate that that's really true, let's come up into our order history. And let's find the ones that executed here. Those were when we put the order, these were the new orders we put in. One for $2, one for $2.30. And then what happened, you can see up here, we were filled on this one, on the 72.90, 72.70, and it hit our stop. $6 was what? 3 times the premium, right? We brought in $2. We said if it's 3 times the premium, get us out. And so that's the one that triggered. That's the one that filled. But we actually got a little bit nicer fill than $6 on it. And then interestingly enough, we'll just jump down here. Our other order filled in the positive. So it's almost like it came down just low enough to nick us out, and then it ran back up. Because then you can see at on Friday, 15 minutes later, 14 minutes later, the other one executed, and we ended up doing nicely on that trade. Okay, so it had different exit rules on it. In any case, the one made money, the other one didn't. And now let's look at SPX here. Okay, so that was last Friday. Well, what's happened since last Friday? Well, here is the 23rd, right here, which was, I guess, Thursday. But Thursday, Friday, Monday, Tuesday, and today, Wednesday, SPX has been below that 10-period moving average and 50. I think the other one's 50. Yeah, 20 and 50 are the ones we're using on this one. And so could we enter new trades? It did not qualify for any bullish trades. And so we didn't. Okay, in our class account, we did not do that. So we didn't put on any new trades until today. I put on a bearish one, and we're going to talk about it. Okay, let's do some sharing with you here. For those of you that are interested in that light blue color, come over here to your settings for your charts. Come over to appearance, and then right there, it says the background. And if you click on it, it'll give you some choices. Okay, so if you have a lighter background, it gives you these choices, or you can go pick a custom, make a custom one. If it's a dark background, it has totally different colors that might look a little bit better using a black background. Okay, so that's all I did, is just picked our little light blue there. And I really didn't mean to pick the grid there, but there it is. And you can hardly see it. I'm going to share with you, George likes the dark mode better. Robin says, the blue is easier on the eyes. All right. Mary Burns, I'm going to get back to you. I am going to share this grid with you, and it's updated a little bit. Oh, that one is not looking good. On this grid, or there's, that's not a grid. It is a script that's bringing in different time frames of return. So year to date, SPX is up 16.35%. Month to date, it's down 1.15. And I went into the script and I changed it so that it would show the dark green color and the dark red color instead of the lighter color. The lighter color, here's the light green, which I must have missed. And it's really hard to see, which is why I went into the script and changed that. I'm going to have to fix that. I won't fix that right now in our class, but I will fix that and update our grid. So second grid is what we use on the market forecast one, where we go and put where the price of the stock is and sell beyond there. We'll get to that in a minute. And this is our linear regression. This one needs to be at a 6-month. We're doing it based on 6 months as opposed to a year. Okay. In the case of SPX, it turns out in a year and in 6 months, the lowest point on the grid is this one right here on March 30th. In any case, I'm going to share the grid with you, and I will have to come back and fix that little spot later. Okay. So if I do share the grid, there we go. I'm going to share. Those of you that are listening to this on a recording, I'm going to put it in a text box here so you can see it. go ahead and hit pause so you can get that information. Those of you that are here live, I'm going to put it into the chat live. Anytime we share a script with you, whether it's a chart or anything else, any other calculation, you need to know that they're not guaranteed as to accuracy or timing. Okay. All right. Rodney says, why is the 724 a closing trade showing a credit? I think that's the one that's that 10 cents. Let's come back here. 724. So we had both of those. So this is, I'm going to say unusual. Okay. This one stopped us out, and that's the one we talked about. Stopped us out at 420. This one, instead of coming back at a small debit, came back actually with a 10-cent credit, which is a little weird and not very common. And I'm going to call that an anomaly. Okay. I'm going to call it an anomaly. If one of you think you know why it may have filled us at that price, which more likely than not wouldn't likely happen in a live market. But again, paper money is a fantastic tool, but it doesn't have perfect execution of everything. Okay. So just know that. Let's see here. There was a lot of comments and some questions here. AJ says, in some classes we use the 20 and the 50 moving average. And I don't know if you mean in this class, sometimes we use it, or in other classes. Let me take a step back and walk you through our models real quickly. Some of you might, I know a lot of you, you're here, we go over this every week, but it's still helpful for a reminder of what the heck we're doing. I have all the rules written out right here in my scratch pad, and maybe I'll just kind of move it up a little bit. These were our original rules that we were using, which was if the SPX was above the 200-day moving average, we'd do a bullish trade. If it was below, let's see, and we'd do 14 days out, always closing it at 7 days out when we got back in our class. We were looking at this and wanted to modify it a little bit because we thought we don't want to wait for the price of SPX to get below the 200-day moving average. That's going to take a long time. In that period of time, we would be putting on bullish trades that we were like, no, these aren't going to work. Market's falling, market's retracing, or whatever the case may be. So we changed it, and we said a couple of things. Things to keep us out of trading when we probably shouldn't be trading. Okay. So we said we need the price of SPX to be above the 200 and the 50 and the 20. And we want to see the market forecast blue line either going up, be in the upper reversal zone. So let's go back to this chart. So be up, pointing up, down here, the blue line, or pointing up, or be anywhere in this upper reversal zone, regardless if it's pointing up or down, or if it happens to be in the bottom reversal zone and it's below 5, and on any of these lines, we can see what the reading is by kind of looking up here in this area on the day that we're on. If it's at 5, well, it probably is not going to go much lower because 0 is the absolute bottom that it can go to. And so it could mean that it's getting ready to maybe hit that bottom and reverse back up. Okay, so we were looking at all of those. And so when I said it didn't qualify for a trade during these days for that model, it was primarily because it was below those moving averages. And what was the blue line doing through there? It was dropping. And actually, I think it was just on yesterday's data that it started to point up. Okay, but it was below the moving averages. Now, if I had looked at it, maybe, well, no, because it just wasn't there. So that's why it did not qualify for us to do any trades, and so I didn't. Okay. The linear regression, however, let's look at it. And I have to tell you, I paid more attention to the market forecast model than I paid to the linear regression model, even though we're testing both of them. Okay. On the linear regression, the idea here is that overall, SPX is bullish. And we are going to put on a bullish trade, so a short put vertical, as long as it's doing a bullish thing. What is a bullish thing? Well, it could be moving off one of these levels. This is the full regression level at 100%. This line up here is the other 100% off the mean, which is right here in the middle. And the mean is trying to hit as many points as it possibly can to get the most touches. Okay, kind of basically what's that average price? So there's our mean. And then the green lines are 50%. These are 100%, and then this just measures out to 50%. And so the idea was, well, if it's bouncing down off of one of these, then it probably is not being real bullish that day. That might be a way that we could trade some of the bearish side of things if it was acting bearishly. And then we had these days here where it's kind of like, gee, is it going up? Is it going down? Is it bouncing up? Is it bouncing down? It was a little difficult to tell. And then just this past week, I drew in this line here where we finally actually have a little bit of a bearish sloping line where SPX wasn't popping above as far as the price goes. Okay, so our linear regression rules over here, left-hand side, say we want to use the 6-month time frame. Right now, the 6-month time frame is showing all the lines going up, showing that we're bullish. And then one will take a bullish trade unless we see some short-term bearish signals. Well, what are those? A bounce down off the linear regression line, either this linear regression midpoint or the 50% line, bouncing down off of basically any of those. Okay, it could be any of those lines. So we said that it could be bouncing down and have a bearish candle bouncing down. Okay, so maybe here it's bouncing down off maybe say here, but when it's a bullish looking candle, meaning up on the day, that's hard to really maybe do a bearish trade on, right? Maybe something like this, it's a bullish candle, it's approaching somewhere that it could bounce down from, but because it's been so bullish, it's hard to go, oh, it's not really bouncing down. Does that make sense? Now, the strike price that we sell in each of these models is a little bit different. In each of these models, in the regression model, we go out and we sell a 17 or 18 delta. And on both strategies, we're going 14 days out, 14 days to expiration. All right. The original rules, and we're still following these with the addition of the, I should point up here, the market forecast. Oh, market forecast here, sorry, I went up a little too high, is that we sell it 14 days out. If it gets us out early because of one of our new exit rules, like getting 50% of it, great. We're happy campers. If we're still in the trade come, say next Wednesday when we have our class, if we're still in a trade, we are going to get out that day regardless of whether we're up or down. Okay, and then we're going to see if it meets the rules for a new trade. Okay. Thanks for helping each other out. And hopefully that was a good enough review on the linear regression. Now, last week we talked about adding some additional rules to the linear regression. And we said, let's do the same thing we're doing with the market forecast rules. Let's say if we get 50% of whatever we were hoping to get, let's get out as well. So in either model, if we get 50% of our credit, we're out of there. We're just going to have it be set that way. Or let's put on a stop. And the stop that we were experimenting with was if we get 3 times whatever the credit is. Now, in many of these trades, we're always going $2 wide. And in some of the trades, we are getting like, sometimes it's $2 of credit, sometimes it's less than that. Sometimes, in fact, one today I haven't shown you yet, we got $1.30 on it. Okay, so for this kind of the stop piece of things, would take whatever the credit was, today it was 130 times 3, and say, okay, if the value of that spread gets up to 390, get us out. It's not going our direction. And we don't want to get anything near a max loss, right? Because on a $20 wide spread, we've got super high probabilities of the option expiring out of the money, but our gain on it's $1.30, which means what's our potential stop, or our potential risk there is going to be what? 1870. So we're risking 1870 to make 130, and we don't want to go close to that at all. So that's why we're putting in this potential exit point as well. If it just kind of looks like maybe it's just not going the right way. You know, we're in a time frame when theta decay should be pretty heavy, very shorter dated options, right? 14 days out. And so we really don't want to risk that much. We don't want to go anything near whatever the max loss could be. Okay, so let's talk about today's trade. Let's see. Let me make sure we're catching everything here. Mario says, Connie, how back in history do I go? Back in a stock, and how much is too much? For what we're doing with the linear regression model, we want to take daily signals. Okay, so if you want to go out a year, fine. In the regression model, we said we're going to do 6 months. The time frame can change if you go out to a 1 year, because on the linear regression, it takes the very lowest point or the very highest point in that 1 year period of time. Now, in the case of the SPX, on the linear regression, the low day was this day here, the 30th of March. And if I change this to a 1 year time frame, it doesn't have to be, but it happens to be the same low point in that year. Okay, so the linear regression will look for the absolute lowest point or the absolute highest point in that period of time. Now, because the SPX is primarily more bullish, you know, we wouldn't necessarily, well, there are periods of time when it can be up here in this higher area, but with the range that it's been trading in recently, it's kind of been staying between the 50% line, and then we had this one point where it dropped down here, and the idea is it gets too far off from the mean, then it's likely to snap and bounce, get back up to the area of the mean, which is right here in the middle, that middle line. George says, on the regression, it would be helpful if correlation coefficient was available to see statistical significance. How can we see or turn it on? I'm gonna have to maybe put that as a homework assignment for me. Okay, going back to Mario to finish your answer. So on the linear regression, we would keep it at the 6 months. And then it doesn't necessarily matter what your other time frames are, because say we're back here on this one, a 6-month chart, 1 year chart, as long as there's a daily here, then the chart is going to look the same, with the exception of maybe if you're going back in time further, yeah, you're going to see more candles, but the placement of the candles, and if they're above or below the 20 and the 50, they're going to be in the exact same spot. What you don't want to do is change the frequency. So you would not want to go to a 2-year weekly. That would totally throw these off, right? Because this becomes a 10 or a 20-week moving average, a 50-week moving average instead of a daily moving average. Mario, I hope that's enough detail for you on that. Yeah, George trying to help you out there as well. Should be comparable to your time horizon, short-term data for a short-term trade. And because the most we're planning, I'm going to say planning to be in the trade is 7 days. That's not a very long period of time, right? So we are wanting to be pretty reactive to what's going on as if there's say we're having a short-term pullback in the market, we want to be able to take advantage of that. Okay. All right. Yeah, Bogus has given us some additional information there about the regression line there. All right, I think we're up to date. If I missed your question, with the exception of the one I said I need to go research about the some additional statistical information, go ahead and ask it again. Okay. All right. Today, I went ahead and I put on a trade today based on the linear regression model. We've talked about, and it wasn't above the 20 or 50 here, so we couldn't do a bullish trade here. I do want to get us to the point we're talking about bearish entry. But let's look at our trade today. On the linear regression model, I had drawn this line in here, and it looked like today it was kind of bouncing down. And this candle has changed a lot today. It was a nice bearish looking bounce, completely going lower than the previous day's candle. And I was like, we should just do a bearish trade there. Okay. We have not very clearly defined any bearish entry rules, but I went ahead and did it. Okay. And so let me tell you what happened here. At one point in the day before the Fed announcement, the market had rallied back, and this was looking like a hammer candle. It was looking quite bullish. Now, it's not the end of the day yet, so we don't know what the candle is really going to look like. But if the market had closed at that point, I could see some people being really bullish based on a decent hammer candle. And a hammer candle, for those of you that maybe are not as familiar with it, I'm going to try to freehand this. Oh, it's not going to work. What's the deal? Okay, I guess I won't draw anything. My drawing tool, this drawing tool isn't working. Let me see if I can get this drawing tool to work. All right, let's go here. And a hammer candle basically has a small, sorry, that's white. That's not the best color here, probably. Let's turn it to black or blue. Blue's a lovely color. Okay, it has kind of a small head like your hammer in your toolkit has. Okay, so that's like the hammer head. And then this long shadow on the downside is the handle of your hammer. And pretty much this is what this candle looked like earlier today. And so it was looking like, man, maybe we're going to reverse here. Then the Fed announcement came out. What did the markets do initially? They responded positively, didn't they? Yeah, they responded positively. So this was looking like a nice reversal candle. And it didn't last that long, maybe 10 minutes or something. And then it started to sell off again. And so we're at a point here where we're seeing, it's really going to close. We'll close it a bit. It might look like, more of a bearish candle. Okay. But earlier in the day, what I did is I put on, this was at 8:22 this morning when I was thinking it was looking quite bearish, put on a call spread. We haven't done any call spreads yet, right? This is a bearish trade. Put on this call spread, we collected $1.30. And I had put on get out at 50% of the gain or 3 times the loss. And so at 1243, it actually filled us. We had said get out at, what did I say, 60 cents. I think I might have put 60 cents on it. And it filled us at 55, which is a nickel nicer, which was fine. Okay. However, about this time, it was kind of going back and forth and back and forth. It was time for our class to start. And so I didn't do any more trades then. Okay. So that's what we did today, but we really didn't have firm rules for it. So what I'd like to do is let's talk about some firm rules that we could add to go bearish. Okay. So if we're talking about the market forecast model, just kind of so we have, and let me pull this here so we're looking at what the bullish version is. So the bullish version says it wants it to be above 250 and 200. Well, because it's been bullish most of the year, most of the time it's above the 200-day moving average. But if we had to wait for it to get down below the 200-day moving average so that it was below all the moving averages, there could be a lot of profit being made through this period of time before it actually would have hit, if it even does, that 200-day moving average. Okay, so if we were to kind of flip the rules, I don't know that it would work that good in this case. Now we could say, what if it's below the 20 and the 50 and the blue line is headed down? Okay, so today, and let's kind of zoom in here a bit. The blue line is headed down. We can just, it's kind of partially hid by the red line, but we can see actually all those lines which measure different time frames is headed down. So we could do something like that, kind of leave off the 200-day and just say if it's below the 20 and the 50 and the blue line is headed down, we could use that as an entry signal. Okay, tell me if you like that with a yes or you don't like that with a no in the chat. I kind of already know what I'm going to suggest that we do, but I would like to see what your opinion is. And we'd want to do the same thing on the linear regression. Okay, let's iron out a bearish entry here. And I would also still say if we get 50% of the target, because it's a profit target, let's get out. If it goes against us 3 times whatever the credit is, then I would say we should get out there as well. Or we could change this and say 2 bullish candles in a series, meaning we're looking at a daily chart, 2 bullish candles in a row. Okay, you guys are liking that so far. Okay. All right, let's do it. And so what I'm going to do here is I'm going to say bearish entry. And then I'll fill this in later. Okay. We're just going to say below 20 and 50. So less than, make sure I get this the right way, 50 and 20 SMAs. I'll clean this up. Okay. SMAs. Okay. And blue near-term line is falling. Okay. I might also say, I might want to be a little bit more defining with the blue line headed down. Because if it's in the upper reversal zone and heading down, we by default already say we are going to be bullish on it because that is a bullish signal. If that blue line is in that upper reversal zone, yeah, it's letting us know that that time frame is having some strength. Now it may come out, right? And once it crosses the 80 and starts heading down, then we might want to consider, okay, now we would be bearish. But I'm going to say if it's turning down in the upper reversal zone, no, that's not going to count. It's got to be lower than 80. So I'll fine tune that. Okay, let's talk about our linear regression. And we're running a little short on our time here, but oh, looks like the market's starting to sell off pretty hard now. Whoa, it is selling off pretty hard now. On our linear regression model. Oh, and I should say that on our, we haven't talked about this yet, in terms of determining a strike price for our market forecast that we've added into the rules, we go 14 days out and we see where the market should not be at that time. So within our probability cone through here, that's where it's likely to be. Guaranteed? No, but it is one standard deviation from the mean. And so earlier today, when I was going out 14 days, I was like, well, I just want to kind of see where it is on the probability cone. And it was pretty much right at that mark. And so we did this 7670 call spread. Okay, now the zone is shifted a little bit as we get here to the end of the day. Let's head over here to the linear regression though. And ignore my little drawings there. I think we might not necessarily have to do a ton of fine tuning here. On this, we were saying we're going to go bullish if the lines are bullish, unless we see a bearish signal. So that bearish signal could mean, no, we're not going to take a bullish trade, and two, we are going to enter a bearish trade. Does that make sense? We'd kind of use the same thing, whatever short-term bearishness means. So if it's bouncing off of one of these regression levels, that could be an entry. I chose today to take an entry bouncing down off of some diagonal resistance. If I had not done that, I don't know that it, well, I guess maybe short term, it's kind of been going sideways here for 4 days and then broke down through. So maybe a short term breakdown. And then we typically will go out and use a 17 or 18 delta. And again, we're still going to go 14 days out. Okay. So bearish entry. What if we basically say, if we see a bearish signal that nullifies doing a bullish entry, we will allow ourselves to take a bearish entry and would still say, take profit at 50% and put on a stop 3 times whatever the credit is to get us out. We need to give it some leeway. We don't want to get, really have a big loss on it. Okay, we would just want to kind of contain that loss. Now, Bogus Chinchilla says blue line down 50% and down. Actually, it could be off of any of these levels. It could be the mean. It could be 50% down here. It could be 50% up here. But sometimes it doesn't go all the way there, which is why I said, well, here's where the short-term resistance seems to be right now. Kind of put that line in. We might have to do a little bit more fine tuning with these bearish rules, but what I'm going to do this week, and those of you that are testing with me on the regression model, if it looks like we can't take the bullish trade, let's go ahead and put on the bearish trade. Okay, it can be at any time during the day. It doesn't have to be based on the closing price. Although this candle has changed a lot today. Anyway, let's do that. And in my case, if it meets those rules, I'm going to put a trade in our class account for that. Now, we are almost out of time here. But if we were to put on an SPX trade here, here's our 14 days out. We're getting bearish signals. So where's our 17 or 18 delta? We can have some choices here. And many times the choice you take is going to be saying, well, which one has the most open interest here in those numbers? 17 delta has more than the 18, so we're going to go with that. Do right mouse click. We're going to say sell vertical. And then we're going to go down to the 75.45. So, oops, that's only 10 wide. We got to go 75.55. That'll spread it out by 2, or by 20 rather. And we want to be selling, not buying. That must have switched on me. Let's open that up. So the credits are like, I'm going to say hardier than what we typically have been getting with the other model, because the other model we're going, where is it? Should it not be 14 days out? And so we're ending out in a really, really small delta here. Sometimes single digits, sometimes it's been around 14. Okay, but this one, we're going to take this one and we're going to say it meets our linear regression model rules. I'm out of time, so I can't put the stop on it, but I will for our class, okay, and get us out. All right, you guys, I need to be done here. Scott Thompson's up next with stock investing for beginners. He'd love to see you there. Subscribe, follow James and I. Have a great afternoon. We'll follow up on this next week. Bye-bye.